In this week's video, we'll review the latest charts to help us answer the question, will waning momentum lead to a painful plunge in the stock market? This is a weekly chart of a popular breadth indicator known as the Summation Index. Hitting the highlights from stockcharts.com, the Summation Index is a breadth indicator derived from the number of advancing issues less the number of declining issues. It's a momentum indicator, and signals can be generated with breadth thrusts, centerline crossovers, and divergences. This is a relatively rare look on the chart of the Summation Index. You can see it dropped below this general area here around negative 600, and then it shot up very, very quickly and exceeded 1200. Just as we've done over the past 3 months or so. This is a factual look. This is something that we can see and measure in the stock market today. Question number one, how rare is this? Summation Index data only goes back to 1998. However, from 1998 to the present day, a move like this has only occurred 4 other times. And what we're looking for, we have to drop below the green line and then move back above the upper green line. This case here is close, but we don't exceed the second line. In this case, we do. We drop below and then exceed the upper line here in 2009. We come back and kiss the line here and then exceed it here in 2012, drop below it 2016, and then exceed it in relatively short order. All 5 of these cases represent a relatively rare and rapid shift in sentiment and momentum, which is a reflection of the net aggregate opinion of all market participants related to all subjects on all time frames. This is concern, and I want to run for the exits, and then we get a rapid shift in the other direction. The second logical question would be, what happened next in each instance? Our study actually uses daily charts. We're showing weekly charts here because it's a little easier to follow. Our line in the sand in each case is derived from a daily chart. It's basically this peak here on the spike. So this peak here, this peak here, the peak here in 2012, and the peak here before a reversal. It's the 2003 case. The peak on the daily chart occurred on June 20th, 2003. That's similar to the peak that we saw on the daily chart of the NYSE Summation Index on February 27th of 2019. This is basically a breadth thrust that we have here. These are the breadth indicators. Now let's look at the S&P 500 walking forward from June 30th, 2003. So we're basically asking what happened next from this point here, which is very, very similar to this point here. The answer is the S&P 500 tacked on an additional 54.85% from the date of the signal here. That does not include the move off of the low. Let's look at the 2009 case. May 12th, 2009 on the daily chart. This peak on the daily chart of the Summation Index is similar to February 27th, 2019. If we look at this date here on an S&P 500 chart and ask what happened next, the answer is really good things for a long period of time. And in all cases, we should point out, from point A to point B, there is a ton of gut-wrenching volatility along the way. 2012 case on the daily chart of the NYSE Summation Index, February 27th, or basically this peak here, is similar to February 9th in 2012. Here's the move in the 2019 case here on the right side of your screen. This is the similar breadth thrust look here in 2012. If we shift from the breadth chart to the S&P 500 chart, what happened next? I think it's probably fair to say the stock market exceeded expectations from this point here. Now let's look at the last case, the 2016 case. This move here, from this point here to this point here, is similar to this move from this point here to this point here that occurred between late 2018 and February of 2019. So here's the peak in the summation index on the 2016 chart. It comes from the daily chart. It occurred on April 28th, 2016, which is this point A here. What happened next in the S&P 500 from the date that is similar to February 27th of 2019? There's quite a bit of volatility in the not too distant future, but the market was able to post a 38.4% gain from point A to point B, and once again, that does not include the move off of the low. 2019 is the fifth historical case dating back to 1998. If we summarize the four previous cases from this point here, this point here, this point here, and this point here, the S&P 500 rallied on average for 1,893 calendar days, which is roughly 5.2 years. The median gain was 83%, and the average gain was 105%, telling us to keep an open mind about better than expected outcomes in the days, weeks, months, and years ahead. This is a chart of domestic equity fund flows, mutual funds and ETFs, from Urban Carmel's Twitter feed. Here's his Twitter handle here. Fund flows have started to pick back up in 2019, possibly in a similar manner to this pickup here that started in November of 2012, and this reversal here that occurred in October of 2016. So let's look at the November 2012 case on the chart of the S&P 500. Here's the end of our breadth thrust signal. This is the point that's similar to February of the present day, and this is where fund flows start to turn on Urban's chart. You can see what happened next. The point of the exercise, this is fuel that can help push markets higher. You can see the cumulative flow here is about as low as it was dating back to 2013, telling us there is potential fuel that could help push markets higher. Here's the reversal in fund flows in October of 2016. Let's look at that on the chart of the S&P 500. Our point in terms of the summation index that's similar to February 27th, 2019 is here. You can see the market gains, but there's a lot of volatility between this point and this point. But when fund flows pick up, really good things started to happen. It's possible this is a turning point in fund flows. Like many things, that falls into the to be determined category. Now let's take these 5 periods and examine them from a big picture stock market perspective. This is 1994 in the NYSE Composite. We're going to walk forward to the present day. Here's our thrust, the end of the thrust that went into the history books on June 16th, 2003. What happened next in the NYSE Composite? Really good things. Fast forward to the next thrust date, May 12th, 2009. What happened next from this point? Stocks rallied, able to break out above this trend line here, which is similar to this look here. If we fast forward to the next thrust date with the summation index, it's February 9th, 2012. What happened next? A strong rally in the stock market that has a volatility characteristic that looks a little bit more like this period and less like this period here. Notice this rally here, for the most part, takes place above an upward sloping 50-month moving average. That's not the case here, and it is the case here. If we fast forward to the date of our next breath thrust, went into the books on April 28th, 2016. What happened next? A very, very sharp rally in the S&P 500 that ended on January 26, 2018. We also had a very, very sharp rally in the NYSE composite. Once again, we came back and we kissed the 50-month moving average, and this portion of the rally occurred above an upward sloping 50-month. It looks more like this leg here and less like this leg here. More like this leg here. Really doesn't look anything like this leg here. And this point here has characteristics similar to this point in here. If we now walk forward to April 18th, 2019, we have a similar signal and a similar look here. We're approaching the downward sloping trend line. In this case, we had a slight pause, and then we moved and then consolidated from a higher level. Here we rallied strongly to the trend line and then had a scare here and a fairly significant give back. In this case, we rallied to the trend line, had a scare and a fairly significant give back, and then a sharp rally. In this case, we consolidated on the other side of the line, came back and retested it, and then rallied. So the moral of the story in the present day, it's possible we're going to get a look like this. It's possible we're going to get rejected here and have somewhat of a right shoulder look. This would be the left shoulder. This would be the head. It's possible we could get rejected here and have a scare or a last shakeout before moving higher. And it's possible we could get somewhat of a failed breakout look and a scare and then a push higher. Telling us to keep an open mind about what happens in the next few weeks or next few months. However, in each case, after the consolidation, the market pushed higher. After the scare and the here we go again, the market pushed higher. After the scare and here we go again, the bulls are wrong look, we pushed higher. After the breakout and somewhat of a failed breakout look, we pushed higher. All of this is occurring above an upward sloping 50-month moving average. All of this occurred above an upward sloping 50-month. All of this occurred above an upward sloping 50-month, and the same can be said for this period here. Contrast this look here and coming back and kissing the 50-month and bouncing with this look here in the early stages or intermediate stages of the dot-com bust bear market. This doesn't look anything like this. And this look here in 2008 during the financial crisis, this look here doesn't look anything like this look here. And those are statements based on the facts that we have in front of us today. So we have to be open to some significant volatility that could take place sometime in the next 3 weeks to 3 months. Volatility that won't necessarily derail the bullish case. All of that is to be determined. It's also possible that you could be looking at this chart and say, this is a waning trend look here. And that's a absolutely positively fair argument. And that might be the case. So if we drop back down below this 50-month moving average, concerns would increase. If we drop below it, concerns would increase. If we drop below it and stay below it, concerns would increase. However, if we take a big step back, the look of this chart can possibly take on a more bullish tone. NYSE Composite, this is 1965 here. This is basically as far back as the data goes on stock charts. This is the devastating 1973-1974 bear market. And guess what? We came down to a flattish 50-month moving average and failed. This point here doesn't look anything like this point here year to date. We're looking at a chart of the NYSE Composite, but the decline in the more widely followed S&P 500 in the 1973-74 bear market was 48%. So we had a massive decline. We came up, recaptured the 50-month moving average. The 50-month turned up, and we had somewhat of a bullish breakout look, and then a retest or failed breakout look where we came back and kissed and actually went below a rising 50-month moving average. This is a 10-year period here with the blue line. What happened next? In the case of the NYSE Composite, roughly an 800% gain from this region here to this point here. And notice, this period looks a lot different from this period. We have price moving above and below a flattish and indecisive 50-month moving average. That look changes here, and the market's character changes significantly after this point here. If we fast forward to the present day, you can at least make an argument that this setup here is similar to this point here. In this case, the S&P 500 fell 48% to this point here. In this case, the S&P 500 fell 56% to this point here. In this case, we rallied off of the low and went above a downward sloping 50-month. In this case, we rallied off of the low and went above a downward sloping 50-month. In this case, we rallied again, allowing the 50-month to turn up, and price for the most part stayed above it. In this case, we rallied again, allowing the 50-month to turn up, and for the most part, price stayed above it. In this case, we had a bullish breakout, and then what appeared to be somewhat of a failed bullish breakout. We came back to an upward sloping 50-month, held near an upward sloping 50-month, and then rallied for quite some time. In this case, we recently came down, and now this looks somewhat like a retest, coming back to an upward sloping 50-month. This point here looks similar to this point here. And this blue line here, sideways consolidation, price hits the line here, 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 and here. This is a 13-year period. This look here is dramatically different from this trending look here. This look here is similar to this 10-year period here. And prior to all of this, in both cases, we can draw a horizontal line here. Price basically went sideways in this case for 11 years before the 50-month turned up. In this case, we can hit price going back 13 years before the 50-month turned back up. If we get this look here morphing into something more like this, or this, or this, our concerns would increase. If we can go on to print a higher high and look more like this period here, then our confidence would increase. Some key bullet points recapping what we've talked about and what we're about to talk about. This is a day-by-day approach based on the facts in front of us today. The longer-term outlook remains favorable. Short-term, we're becoming more vulnerable to a normal and to-be-expected pullback that could range realistically based on history anywhere between 4% and 10%. This is not an exercise in forecasting. We're simply making probabilistic statements based on the charts in front of us. We'll continue to take it day by day with an open mind about a serious shift in the news cycle, and that includes the potential for a serious and negative shift in the economic data, something that has not happened yet. We're open to a negative shift in the technical data, something that may happen but has not happened yet. And we have to keep an open mind about an outcome like this or this or this. This is what we have in front of us today on April 18th, 2016. How about asset class behavior? Does it align with this type of hypothesis or this type of look? And does asset class behavior align with this type of potential looking out 1 to 5 years? So as we look at these charts of ETFs, keep in mind these dates where we had the very, very rare move in the summation index. 2003, 2009, 2012, 2016, and the present day. Home builders in isolation, we came back and tested an upward sloping 50-month moving average. We broke above this downward sloping trend line. You can make an argument that this look here, with the breadth thrust in the books for the NYSE composite, is very, very similar to this breakout here that coincided with the 2019 thrust case. This look here is very, very similar to this breakout here that coincided with the 2012 breadth thrust case. Present day look is similar to this bullish breakout here that coincided with the 2016 case. Similar breakout in the present day, and we also have the thrust. This is stocks versus bonds as of April 18th, 2019. You can make an argument this is your left shoulder, this is your head, this is your right shoulder, this is a bullish breakout, and this is a retest of the neckline. All of this occurred above an upward sloping 50-month moving average. Contrast the look of this consolidation and mess here in the present day that occurred above an upward sloping 50-month moving average. This looks quite a bit different than slicing through a rolling over 50-month moving average that occurred here in late 2000, early 2001. And this look here is quite a bit different than this look here. We sliced through a flattish 50-month moving average in late 2007, came back up, tried to retake it and failed, and really bad things happened for risk assets. This look here looks quite a bit different than this look here and this look here. It's also noteworthy, if we put the dates of our breadth thrusts on the same chart, in the historical cases, after the thrust, stocks significantly outperformed bonds. After the thrust, stocks significantly outperformed bonds, significantly outperformed in the 2012 case. 2016 case, we get a thrust, a reversal near an upward sloping 50-month, and then stocks significantly outperformed bonds. If the pattern holds, and that is to be determined, it is possible stocks are going to significantly outperform bonds. And we're also above the neckline here, and we know the potential upside with an inverse head and shoulders pattern. Everything that we just said applies as long as we remain above these red lines and we remain above an upward sloping 50-month. If this look morphs into something like this, or this, or this, then our concerns would increase. We covered this chart on our blog, short takes, financials, XLF relative to the S&P 500, somewhat of a tame upward sloping trend channel. If we drop the dates of our breadth thrusts on this chart, you'll notice after the thrust, XLF outperforms. After the thrust, outperformance, lower end of the trend channel. Thrust, lower end of the trend channel, outperformance. Similar setup in the present day to this point here, and from a thrust perspective, this point here. Similar concepts here so we can move more rapidly. Industrials versus the S&P 500, thrust, 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 outperformance, outperformance at the lower end of the channel, outperformance coincides with the thrust. Looks like we're getting a similar look coinciding with the thrust at the lower end of the relative trend channel. Consumer discretionary, XLY relative to SPY. Resistance here dating back to 2018. Getting what looks like a bullish breakout from a smaller left shoulder, head, right shoulder, inverse head and shoulders pattern. And for you IBD people, from a psychology perspective, we have somewhat of a cup and a last shakeout handle look to this relative chart. Notice all of this is occurring above an upward sloping 50-month moving average. Semiconductors weekly, SMH relative to SPY. So this is a relative chart. Semiconductors breakout relative to the S&P 500 here in 2016. We also get a breadth thrust here. MACD, this looks like a counter trend move within the context of an existing downtrend. Now we're starting to look like what could be a new uptrend. This breakout occurs where MACD convincingly clears the center line, telling us from a probability perspective this is looking more like the early stages of a new trend. This is looking more like the early stages of a new trend. Now let's talk about this bullet point here where my cursor is. S&P 500 daily. This is the look of the chart as of the close on Thursday, April 18th. The markets were closed on Friday, April 19th. Very, very strong trend here that's been going on now for several months. CCI on a daily basis starting to show a little bit of waning momentum here. There's a divergence here on this move higher relative to this point. ADX, longtime viewers remember, measures the strength of a trend. When black ADX gets above both green and red, it's telling us that the trend is starting to get extended and more vulnerable. MACD, we have somewhat of a waning momentum look as well. MACD higher here. Price moves higher. MACD is lower and closer to the center line. And we did get a bearish cross. Red now is above black. All of this just says we've got some waning momentum issues here. Notice MACD is above the zero line. So if we get a cross, this looks like a counter trend move within the context of an uptrend. This cross occurs above the zero line. A counter trend move within the context of an existing trend. This is to be determined. We're still above zero. Waning momentum, some signs of it on the daily chart. What about the weekly chart? Weekly chart looks a lot better. This is our sleepy trend look here. This would align with this being a counter trend move within the context of an existing trend. This is not an extended trend look on weekly ADX. This is a favorable look. CCI, no waning look here really. I guess you could make an argument, possibly a slight divergence forming, but not really. Haven't even dropped below 100 yet. And MACD here also says early stages potentially of a new trend. We covered this from a NASDAQ and S&P 500 perspective. When MACD crosses the center line here, from a probability perspective, this is where your new uptrend started. At some point, we know with almost near certainty, if this trend continues, we're going to get a 4 to 9% pullback. Are we starting that now? Absolutely, positively, no idea. We take it day by day. There are some minor cracks starting to show in this trend here. How we manage it going forward will be 100% dependent upon what's in front of us day by day and week by week. Our bull-bear roadmaps that we covered back on January 11th and have updated every week in these videos. Anything concerning there? Right now we have an uptrend above the moving average cluster. The 200-day in orange is starting to try to turn back up. This look here has not morphed into anything like this. Really doesn't look anything like this. We blew through the 200 and retested it. That's not really anything like the look here. This is a series of lower highs and lower lows near the moving average cluster with the 200-day rolling over. We have a series of higher highs and higher lows with the 200-day trying to turn back up. If this morphs into something like this, or this, our concerns would increase. If we get our 4 to 9% pullback now, how we handle it will be dependent upon what the data and asset class behavior and the model is telling us at that time. Present day really doesn't look anything like these cases. And these are the looks that we outlined way back on January 11th when price was here. We said this would be a constructive look. This would be constructive. This would be constructive. Consolidation above the moving average cluster with the moving averages trying to turn back up would be constructive. So far, we have a constructive look. We'll see how things play out in the days, weeks, and months ahead. The amount of useful and valuable information that we're learning within the context of the Bird Strike project that's been going on now for over 90 days, it's immeasurable and it's going to be invaluable. And thus, we are going to stick to our guns in these dates here and get back to the research in an extremely focused and efficient manner. How long we shut this down after April 26 falls in the to be determined category. As long as it takes. As long as the Bird Strike project is uncovering useful concepts, we will continue to work. These are the major bullet points as of April 18th. And as always, under our approach, the only way all of this works is if we head into next week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.